Three banks told their richest clients something last week: Goldman Sachs, UBS, JP Morgan. Within 48 hours, identical conclusions. The same asset, the same warning, the same direction. And almost none of it reached the people whose savings are about to be devalued. I have those research notes. I have read every word. And what I am about to tell you is not a summary. It is a translation of what the institutions managing more capital than entire nations are doing with their money right now, while you are being told to stay calm. Let me start with the word nobody wants to hear: devaluation. Not the dramatic kind with headlines and panic. The quiet kind. The kind that happens to your savings account while you sleep. You are earning 4% interest if you are lucky. Most retail banks pay closer to 1%. Meanwhile, prices are rising at 5% annually. Every month your money buys less, not because you made a mistake, because the system is designed to transfer your purchasing power to the largest borrower in the world, the government that prints the currency you are saving in. This is not new, but it has reached a level of urgency that I have not seen in 40 years. And the proof is not in what these institutions are saying publicly. The proof is in what they are doing with their own capital. Goldman Sachs just published research describing their position on gold as constructive. That is institutional vocabulary for we are still buying. They published this after gold suffered its worst monthly performance in 13 years. A 12% decline that retail investors interpreted as the end of the gold thesis. Goldman's analysts doubled down. Why? Because they understand the Middle East conflict has created sustained inflationary pressure. The Federal Reserve cannot cut rates aggressively, and the United States government is spending at a rate that has no historical precedent outside of total war. The United States national debt is above $38 trillion. The annual deficit is running at approximately $2 trillion per year. The interest payments on existing debt have now exceeded the entire defense budget. The government is paying more in interest on money it already borrowed than it spends on the entire military. When a government spends significantly more than it earns, it has two options: borrow and pay interest, or monetize, which is a polite way of saying print money and buy your own debt. The first option works only as long as the interest burden is manageable. When the interest burden becomes larger than your defense budget, that option stops working. You are forced to print money, devalue the currency, transfer purchasing power from savers to the government. Every major government is choosing the second path right now. They are choosing inflation over austerity because the political consequences of spending cuts are unacceptable. This is not a prediction. This is happening. And this is why Goldman Sachs is constructive on gold after a 12% decline. Now let me tell you what UBS is telling its wealthiest clients. UBS identifies four primary drivers for gold. The first is stagflation risk. Stagflation is the nightmare scenario where prices rise and growth slows simultaneously. The Federal Reserve's primary tool becomes useless because cutting rates accelerates inflation while raising rates kills growth. The central bank is paralyzed. In every prior stagflationary episode, the 1970s being the most instructive, gold outperformed virtually every other asset. UBS is flagging stagflation as seriously underpriced. The second driver is dollar weakness. The dollar's reserve premium has been the primary mechanism suppressing gold prices for decades. UBS's view is that the dollar will weaken over the medium term. The basis is fiscal reality. Sustained deficit spending, monetization risk, and eroding confidence in the dollar's reserve status as sovereign nations watched the United States freeze Russian assets and concluded that dollar dependency carries political risk. The dollar does not need to collapse. A gradual, sustained weakening over several years is sufficient to drive gold significantly higher. The third driver is lower interest rates. This sounds counterintuitive given the Fed cannot cut rates now because of inflation. But UBS is making a medium-term argument. The debt arithmetic, $38 trillion in debt, interest payments exceeding the defense budget, creates fiscal pressure that sustained high rates cannot accommodate indefinitely. At some point, the Fed will be forced to cut rates even in an inflationary environment. When that happens, the opportunity cost of holding gold disappears. The fourth driver is the one that matters most: central bank buying. Central banks globally purchased over 1,000 tons of gold last year. This is the continuation of a trend accelerating since 2022. Gold now represents approximately 20% of emerging market central bank reserves. The central banks buying are reducing exposure to a reserve system that demonstrated through freezing Russian assets that it is subject to political discretion rather than rule of law. The dollar's reserve status was built on trust. That trust has been structurally compromised. The precedent has been set. Every sovereign treasury has adjusted its risk calculus accordingly. Now I want to address the 12% monthly decline in gold, because if you own gold, you experience that drawdown. Does this change the thesis? The answer requires understanding why the decline happened. The decline was a liquidity event, not a fundamental reassessment. The Middle East conflict caused oil to spike, producing losses across virtually every asset class. Hedge funds operating with 40 times leverage faced margin calls. When you are leveraged 40 times and positions move against you, you need cash immediately. Gold is one of the most liquid assets in the world. So leveraged funds sold gold, not because they believed it was overvalued, but because it was the most convenient source of liquidity. The evidence is in the physical market. During the same period when paper gold prices declined, physical gold inventory in COMEX vaults also declined. Delivery requests were elevated. If the selling reflected genuine reassessment, physical demand should have weakened. Instead, buyers of physical gold accelerated accumulation at lower prices. The paper market said panic. The physical market said opportunity. When paper prices fall but physical demand rises, the paper market is mispricing the asset. The correction is temporary. Now let me tell you about China, because it is the most important development Western media has ignored. China's regulators authorized 10 major insurance companies to allocate up to 1% of their total assets into gold. UBS analysts found Chinese gold ETF inflows remained robust, while North American flows were negative. 1% of assets managed by China's major insurance companies represents approximately $27 billion of potential gold investment. Insurance companies are long-duration investors. Their horizon is decades. When they build a gold allocation, they hold and add. They represent structural physical demand that paper volatility cannot suppress. The pattern is clear. Western paper participants selling, Eastern physical participants buying. This is a transfer from leveraged short horizon holders to unleveraged long horizon holders. Every time this occurs, the pool available for forced selling shrinks. Let me give you 3 questions I use to evaluate any major allocation decision. First, what are the most well-resourced institutions actually doing with their capital? Central banks are buying gold at the highest pace in decades. Chinese institutions are building their largest ever allocation. Goldman is constructive after a 12% decline. UBS is telling clients to stay bullish. When institutions with the deepest resources converge on the same asset simultaneously, that convergence deserves attention. Second, what is the crowd doing? Retail sold aggressively during the crisis. Sentiment hit extreme bearishness. When everyone who will sell has sold, the marginal buyer determines direction. JP Morgan's data shows when equity positioning has been this bearish, the S&P 500 delivered an average 8.2% return over the following 3 months. Maximum pessimism and maximum opportunity coincide. Third, are the forces driving this thesis short-term or long-term? The answer is they are structural. Fiscal excess, monetary debasement, de-dollarization, sovereign reserve diversification. These did not emerge from a single policy and will not be resolved by a correction. The U.S. deficit reflects structural spending commitments built over decades. De-dollarization reflects weaponization of dollar assets that cannot be undone. The Chinese insurance program reflects a regulatory decision that will compound over years. The reset underway is not a market event. It is a monetary event. The The gradual devaluation of fiat currencies relative to scarce physical assets is how governments resolve the tension between debt obligations and unwillingness to cut spending. It has happened before in every major fiat currency. The institutions that understand this are positioning quietly at prices that volatility created. The people who get hurt in a monetary reset are not the ones who bought the wrong stock. They are the ones who held wealth in the asset being devalued. Cash, bonds, savings accounts. While institutions quietly moved capital into assets that maintain purchasing power. Understanding this mechanism is the first step to not being on the wrong side of what is already happening.